So silver has taken off. And I think there's a growing realization that it's not just silver, but China is actually a major source, global source of processed rare earths, antimony, cobalt, all these things which are needed now. So the entire base metals sector, or basket of them, has actually moved up, begun to move up. So we're beginning to see inflation, which so far is not being discussed at all in monetary circles. And I think that is interesting, and I think it's irresponsible, actually, to just sit on that story, which is really what the Fed and other central banks have been doing, other G7 central banks.
Alasdair Macleod argues that 2025 has been a turning point, not because of a single dramatic event, but because gold has begun to anticipate deeper structural stress in the US dollar system. In his view, gold's steady strength reflects markets quietly discounting future monetary instability rather than reacting to headlines. He links this shift to growing geopolitical fractures, unstable trade policies, and worsening US-China relations, which have pushed Beijing to prioritize control over its own strategic resources. China's retreat from supplying silver to global markets, combined with its dominance in processed rare earths, antimony, cobalt, and other critical materials, has tightened supply chains and lifted the entire base metals complex. Macleod believes this is already laying the groundwork for a new inflationary phase that policymakers are largely ignoring. On inflation, Macleod is blunt. He believes central banks, especially the Federal Reserve, have effectively abandoned the fight. While official narratives downplay inflation risks, he sees policy actions telling a different story. The return of quantitative easing, the end of tightening, and the focus on maintaining liquidity suggest deep concern beneath the surface, particularly about overstretched tech valuations, speculative excess in digital assets, and a stagnating real economy. Macleod emphasizes that inflation should not be viewed solely through consumer price indices, which he considers flawed, but through the erosion of purchasing power. From that perspective, he expects the dollar to lose far more value in 2026 than most investors currently anticipate. Looking ahead, Macleod warns that the real fault line lies in sovereign debt markets. He disputes the idea that liquidity is scarce, arguing instead that banks are reluctant to lend in an increasingly risky environment. Rising long-term bond yields, shifting Japanese capital flows, and a weakening carry trade all point to mounting pressure on U.S. treasuries. As yields climb, equity valuations become harder to justify, leaving markets vulnerable to a sharp reversal. When that happens, Macleod believes forced selling, collapsing collateral values, and foreign capital flight could amplify the downturn dramatically, turning what looks like a routine correction into a systemic shock with far-reaching consequences. Now, we present the clips from Alasdair Macleod's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
2025 is the year when gold started front-running what are inevitable developments in the dollar. I think that probably puts it in a nutshell. And it creates, if you like, the background for what we can see in 2026 and 2027. The geopolitics as well, the ups and downs of trade, discussions, hardly discussions. I think that global trade has been screwed, really, by American policy, which has vacillated one way and the other. The relationship between America and China as well, I think, is a big, big topic. And it's led China, I think, to take some very serious decisions to protect its own resources. Its own resources being, we've got, silver. That she's stopped supplying silver automatically to the rest of the world, which was what was depressing prices of that. There is absolutely no doubt. So silver has taken off. And I think there's a growing realization that it's not just silver, but China is actually a major source, global source of processed rare earths, antimony, cobalt, all these things which are needed now. So the entire base metals sector, or basket of them, has actually moved up, begun to move up. So we're beginning to see inflation, which so far is not being discussed at all in monetary circles. And I think that is interesting, and I think it's irresponsible, actually, to just sit on that story, which is really what the Fed and other central banks have been doing, other G7 central banks. So quite a lot to talk about in that sense, but I think also we need to look forward to what's likely to develop in 2026 and 2027. Particularly the Fed has given up on trying to control inflation. The official story is inflation is no longer a real problem. Okay, it's 50% above the desired level, but we're not worried about it. And therefore, we end quantitative tightening, and to ensure there's ample liquidity in the system, we're going to start quantitative easing. I think actually that underneath it all, the Fed must be very, very concerned about the tech bubble, about that bursting, about the Bitcoin bubble, the consequences of that bursting. I don't know to what extent they take indications of the gold price going higher and silver price going higher, and what that might mean. I mean, they've had all that, sort of sound money stuff drummed out of them, in effect. But I think they do actually see the US economy stagnating and therefore needing monetary support. Now, they're going about it completely the wrong way, but, it's irrelevant. That's the way they do it. So on that basis, I think, there is a big change, and it is going to be very, very inflationary. I think that's the key point to understand. Inflationary in the sense that, and I always prefer to look at it this way, inflationary in the sense that what will happen is that the dollar's purchasing power will decline a lot more than people think in 2026. So I think 2025 gives us the background to that. I actually don't share the Fed's analysis on this. I think there is ample liquidity in the system. The problem is that banks are getting worried about extending credit. And so that's the real issue. And the idea of reducing interest rates and doing QT and therefore flooding the bank's balance sheets with the most liquid form of deposits possible, i.e. reserves at the Fed, is not going to be the solution. It really is not. Banks, I think, are, if you just listen to Jamie Dimon, what he's been saying, banks see this environment as being not at all friendly. And the other thing, of course, is that as far as the Treasury is concerned, they have a problem because the only debt that's really selling is very short-term debt, which actually tells us that global investors see the Fed sliding into a debt trap. What's the right rate for a 10-year bond or a 30-year bond? I know what the market's saying, but the market is, if you like, in a sort of stasis on this. But if the Treasury really tried to test it, I think you'd find that yields would start going up quite dramatically. Why? Because they reflect the risk, if you like, inherent in investing in long-term US Treasury bonds. Now, everything else takes its tune from that, including equities. What we've seen in US Treasuries is a consolidation phase from about 2022, after that very, very sharp rise, following the economy coming back post-COVID. It looks to me, there are signs that yields are breaking out higher. The Japanese yield is going higher, and Japan is, if you like, not being very helpful because with its bond yields rising, they are now getting sort of attractive to Japanese institutions, the pension funds, insurance companies, and so on and so forth. The reason that they are the largest holders of US Treasuries is because they were getting superior returns there compared with domestic bond markets. Now that's changing. The gap is closing. Furthermore, with interest rates rising, and presumably we'll get a rise in Japanese rates in the next day or two, which is all discounted, admittedly. But with those rates rising, the carry trade is no longer so profitable. In other words, the return on the carry trade is no longer really sufficient to cover the currency risk. So putting the whole thing together, Besant at the US Treasury can see a problem down the line. So what will QE do? Well, QE basically, what will happen, I think, is that the Fed will be buying short-term T-bills in the market, which bolsters the reserves of the banks on its balance sheet, which looked another way from the bank's concern means that their deposits rise, and they will effectively take those deposits and use them to buy US Treasuries. So all this is about funding US Treasuries at the moment. I think that the real problem which we now face is that as these bond yields at the long end begin rising again, that'll undermine the equity bubble. And we're already seeing the equity markets looking tired, let's put it that way.
Alasdair Macleod warns that the financial system is now facing a dangerous escalation of counterparty risk, particularly within derivative markets. He explains that stress emerging in silver derivatives will not remain isolated, but will inevitably spill into gold and other commodity contracts, then cascade through interest rate swaps, currency swaps, and the broader derivatives complex. Because the same institutions operate across all these markets, confidence can unravel rapidly once doubts surface. In Macleod's view, the system is standing on the edge of a cliff, with most participants unaware of how close they are to a sudden and severe breakdown, leaving those who misunderstand these risks especially vulnerable. He also frames aggressive bank buying of U.S. Treasuries, including moves by institutions like J.P. Morgan, as a sign of desperation rather than strength. Macleod argues that regulatory changes and financial repression are being used to force banks into absorbing government debt because private demand is weakening. Banks, he notes, are unwilling to lend to the real economy as recession risks grow, unemployment rises, and bad debts loom. At the same time, global capital is beginning to question long-term U.S. debt sustainability, while China positions itself for a post-dollar world by accumulating gold and reducing exposure to Western currencies. His central message is stark. Wealth tied to credit is at extreme risk. Fiat currencies are heading toward collapse, and only real money, primarily gold, offers protection as the current monetary system approaches its endgame.
Well, yeah, I mean, as I said earlier, China's worked out a long time ago what the end game was, and I think they understood that America's power is entirely tied to the dollar. They haven't actually done anything to destroy the dollar. I mean, why do that when the Americans are destroying the dollar themselves? Has been their attitude. They are very patient. They don't. The Chinese don't go in and try and sort of manipulate things their way. Not at all, in a currency sense, anyway. I mean, they'll pursue their own interests, but they won't destroy anybody else's interests. And you see this in their approach. There's the difference in the approach between America and its imperialism and China and its, if you like, oversight of BRICS and the Shanghai Cooperation Organization. China is about doing domestic business, international business deals in the interests of China. America interferes politically. First of all, I mean, it'll lend money to countries which don't need it. It will bribe the politicians. That's what overseas aid is. It's also what the British have been doing, incidentally. And as well as that, if, let us say, even after doing those two things, a minor country is non-compliant in their terms, then they arrange regime change. I tell you, the rest of the world hates America for the way it's behaved, which makes it doubly easy for China to come along and say, have I got a proposition for you? The world has moved away from us in the West. We're history. And it's all industrializing very, very rapidly, which is another point. I mean, if you look at the value of commodities priced in gold, which is relatively constant in terms of its purchasing power over long periods of time, commodities are cheaper than they've probably ever been priced in gold. Now, a lot of that is because gold is front-running the collapse of the dollar. But what it means is that in 2026, you're going to see commodity prices rising back towards where they should be compared with gold. And I reckon base metals are valued at under 20% of where they should be currently against gold, which implies that to get back to where they should be, they're going to go up 5 times, measured in gold. Where does that leave it in falling value of fiat currencies? I mean, you're going to see the coppers and leads and zincs and all the rest of it, and iron ore going absolutely sky high, measured in dollars, and also energy too. That's another thing. I think that the oil price, it is now so low, measured in gold. I mean, we know that there's an awful lot of supply and all the rest of it. I mean, today things have sort of jumped a little bit because of America's ban on Venezuela, sort of thing. But I mean, that's all noise. I mean, the fact of the matter is that when the purchasing power of a currency goes down, then the price of commodities goes up. And I think that's going to be the really big surprise in 2026. You're going to see massive commodity and raw material price rises with the knock-on effects, which will be added to the consequences of Trump's trade policies, undermining the economy, and the Fed basically going into overdrive, issuing currency, issuing bank deposits through QE, trying to save the whole system. The collapse could actually be quite rapid once it starts. But I think the point to note is that, if you actually understand what gold is telling you, it's actually telling you that next year is going to be awful for financial assets, and the economic outlook is front running what's going to happen to the dollar.
Yeah, so important to hear. So, Alasdair, thanks so much for your time today. We've sort of covered quite a lot. And my last question is, what is one message you want people to take away from our conversation?
Well, I mean, the answer is that any wealth tied up in credit is at risk, and severe risk of going down to zero. So you need to understand what the difference is between money and credit. And in law, common law, not American jumped up legislation, but in common law around the world, money is only gold, possibly silver, but principally gold, because that is what the central banks have protected themselves with. They don't buy silver for very good reasons. It's an industrial metal. It's being priced as an industrial metal. It's really gold. I think there are investment alternatives, as it were, but they'll all be in the commodity space, not in AI, not in whatever. I mean, there's going to be, that's the potential for a crash in equities, I think is enormous. I mean, we could see 90% of the S&P, NASDAQ, whatever, being wiped out. It wouldn't surprise me at all.
As 2026 approaches, the outlook for gold and silver is increasingly shaped by long-term imbalances rather than temporary market narratives. Persistent government deficits, rising debt burdens, and the quiet return of monetary accommodation are steadily undermining confidence in fiat currencies. In this environment, gold is expected to continue acting as a forward indicator of stress, reflecting declining purchasing power before it becomes obvious in official data. Demand is likely to remain broad-based, coming not only from central banks, but also from institutional and private investors who view gold as a form of monetary insurance against systemic risk. Silver is positioned to follow the same direction, but with far greater intensity. Unlike gold, silver sits at the intersection of monetary demand and essential industrial use, which tightens supply when economic or financial stress increases. As paper claims grow increasingly disconnected from available physical metal, even a modest shift in investor behavior could trigger sharp price repricing. This makes silver particularly sensitive to disruptions in confidence, where moves higher may occur suddenly and without warning, driven by scarcity rather than speculation. Share your thoughts in the comments section below. If you found this insight useful, make sure to like, share, and spread this update to others watching the silver story unfold. Your support helps keep these deep dive analyses coming.